Greetings to you all. Yeah, I'm here today about we are on week 2 of mathematical literacy, grade 12. Yes, let's talk about some personal income things and stuff. It's all about tax, but step by step it says it follows: personal income tax, taxable and non-taxable income, and rebates. Don't forget the UIF and the VAT. Yes. Okay, now let's talk about income tax. Income tax is about amount deducted from your earnings by the government. This money is used to run the country. The amount of income tax paid depends on the amount of money you earn. Yeah, the 15% that you earn is out. There are several steps to calculating a personal income tax, and you therefore have to make sure that you understand the important terminology and can perform the steps in the right order. Okay, let's now talk about gross salary. You know that the gross salary is the total amount earned in a month. This includes all type of salary, overtime, bonuses, all the things. Let's talk about some deductions there. Okay, now deductions, amounts that are needed to be subtracted from the gross salary before the money is deposited into employee's bank account. This include items such as UIF, pension, medical aid, trade union fees, loan repayment, tax, and therefore then there's net salary. It's also known as take home pay. You can hear the word take home pay. Take home pay, always that's the money that you get like after the things, boom, it's yours. The money is yours. Okay, let me say formally, also known as take home pay. This is the amount that is deposited into an employee's bank account. It is calculated as follows: net salary, which is equal to gross salary minus all the deductions. The money left is yours. You take it home. That's why it's called take home pay. Now let's go to income tax. This is a tax on all sources of income. For example, salary, interest income, rental income. Then it is calculated on the taxable income. Then there is taxable income. This is different from net salary, although the calculation looks similar. Taxable income is equal to gross income minus tax deductible deductions. Gross income. Yes, gross income. Gross income, it differs from above because it includes all forms of income. Example, salary, rental income, everything. It includes everything. Now let's go to tax deductible deductions. These are specific deductions that are subtracted from the gross income before tax is calculated. Individual deductions: pension fund, retirement annuity fund, provident fund, legal cost, wear and tear, like your assets, you get me, clothes and stuff like that, some donations. Then there is UIF. Yes, unemployment insurance fund. It's like when you are employed, unemployed, like employee have to contribute 1% of their gross salary. 1% of their gross salary. The pension fund is 7.5 of your salary. Yeah, but it's optional. Okay, depending on the government you work for. Depends on the government you work for. Okay, now let's go to when calculating gross income. Is the total amount of individual's income before the deductions. We already been there. Okay, now we talk about the tax rebates, like the rates of tax individuals table. Okay, here's the table. The table goes as follow. Okay, now we have to calculate using the tax rebates. For instance, let's say that D is earning a 30,000 salary per month. Then we know that D have to pay some pension fund and UIF. As I calculated here, pension fund is 7.5%. Then 7.5% of 30,000 is 2,250 rands. Then again we have to calculate the UIF. Then the UIF is 1%. 1% of 30,000 is 300. Then we're gonna combine those taxes and they cost 2,550. We take that 30,000, we deduct 2,550. which is 27,450, and obviously you have to take that money and multiply it by 12. Then we multiply it by 12, which is 329,400 per year. This is the taxable income. Yep. Then we go back to our bracket. We check all the bracket carefully. Don't make a mistake, because I've seen a lot of students making a mistake. We check and check. We check, like, then you see the second bracket is 321,600, which is not the one, because our money is equal to 329,400, which means we belong in the third bracket. Then okay, take our pen and paper, calculate. You take the 329,400, you put it on the second bracket. Okay, now let me not confuse you guys. Look at the second bracket there on your right. Is 67,144 plus 31%. Then when you write it, it's gonna be 61,144 plus 31 over 100, or you can k 0.31. It's fine. Then into brackets put in 329,400 minus 321,600. Yeah, I believe I'm clear. Now the second step is equal to 67,144 plus 31 over 100 multiplied by the answer you found there on the right bracket. Then after multiplying it, you're gonna get 2,418. Okay, now you take the 2,418, you add it with 67,144, which is 69,562. Then we are done. That's a simple thing, very easy. Then let me explain this bracket. On the left hand side, this row, they call it a bracket. Then when you go on the right side, there, the first amount there, the 67,144, is called the fixed amount. Is a fixed amount, money that doesn't change. Okay, then we have the percentage, then we have the bottom of the bracket. Yeah. Okay, now I think I'm done with week 2 work. Yeah. Oh, the tax, the VAT amount. Okay, we'll test that. Just give me 2 minutes. And now let's talk about our last topic, which is VAT. We all know that VAT means value added tax, which is 15% in South Africa, right? Then let's get into the topics of VAT. Deep inside VAT, in VAT we know that there are interest, like VAT. Interest is money earned on investment, or the money paid to borrow the money, like when someone said, okay, let me borrow you 400, then you say, but the interest is 15%. Then you know that you have to take out 15% of that 400. That's interest, exactly. Then there's an interest rate. The interest rate is the percentage at which interest is earned or paid. Any interest, like the amount that you have earned out of borrowing the money. You get me? Yes. Then there is repo rate, which is the percentage at which banks borrow money from reserve banks. Yeah. Unless repo rate is not like a heavy thing about school. Just repo rate is about banks and stuff like that. You wouldn't find it in an exam or a test. Okay, then there's a principal amount. The principal amount is amount initially invested or borrowed. That's the amount that you give a person. Let's say I give you 400. That's the principal amount. Yeah, principal, that the owner, the original amount. Yes. Then there's this simple interest. The simple interest is calculating the original amount borrowed every year. So like, the simple interest, like let's say it's 15%. I borrow you 400. That 400 you have to bring it at 15%. Yeah, you're gonna bring it exactly as 15%. It doesn't change. You see, you bring the 15% every year. Let's say I borrow you 400 per year. You have to give me for 3 years. You give me the 15% for 3 years. You get me? It doesn't change. 15% for 3 years. The 15% of 400 for 3 years. Rather than compound interest, the heavy one, complicated one. The original amount in the first time that you calculated on original amount plus interest earned in the previous time period, like as the interest on top of interest. Let's say I borrowed you 400. When I borrowed you that 400, you give me back my 15%, then I add that 15% on top of 400. You see, let's say it become 450, like on the second year 450 plus 15%. Yes, it's complicated, but I know that you get me. Okay, I'm done for today. That's the lesson. Yes, I am done for today. That's the end of the lesson. It's the end of the lesson, my fellow students. Yeah. Okay, now don't forget to subscribe and like. Hit the comments there. Say what do you like, what you don't like. Now we're gonna hit it on week 3. I'll see you next week on week 3. We're gonna be hitting on tariff systems, electricity tariffs, telephone tariffs, municipal tariffs, bank tariffs, transport tariffs, table, graph and formula. So you guys need to just revise, then they revise, then they understand. Don't just rely on this page, guys. You have to do it on your own sometimes. Okay, now I'll see you in the next video. Ciao.